Welcome to the KMG Fiduciary Partners Podcast. Here, we'll cover important topics on financial planning and asset management to help keep you informed and inspired for long-term success on your financial journey. Let's join the KMG team now for today's topic. Welcome to 10 Minute Advisor, brought to you by KMG Fiduciary Partners. My name is Cameron Kaiser. I am a CFP professional and a wealth advisor here with KMG. I'm here with Rob Thompson, who is a CPA and also a wealth advisor with KMG. So, Rob, how you feeling?
A little tired. Cam and I, we just got back on, it was honestly quite the excursion. So I flew into Denver and picked Cameron up, who was already in Denver. We kind of planned a trip to go see a client that lives in Rock Springs, Wyoming. So he's up there, and I'd never been to Wyoming, but I know one thing, I certainly didn't expect it to be what it was. It was super pretty.
It was nice, and I don't think I've ever seen so many Angus cows in one drive than that trip.
No, actually, Mark, that is true. Like, Cam was flipping out about all that. He was like, okay, well, so then we got into the conversation of how much beef comes from just one cow. Which, do you remember
I think it was close to 1,000. That was my. It was like 700. Probably depends on the mass.
I thought it was like 400. But it's a lot of burgers either way.
Okay, so can you explain the format to everyone, please?
Yeah, so today we're going to be comparing traditional IRAs and Roth IRAs, and we're going to try to keep it in 10 minutes or less.
As always, we have our producer Mark here at the stopwatch so we can stay true to the objective of 10 minutes or less.
Perfect. If you guys are all set, ready to go.
Hit it. All right, Rob, where do you want to start this thing?
I'm thinking maybe you just give high-level sort of the differences between a traditional IRA and a Roth IRA.
Okay. Yeah, so the main difference between the two is in the manner in which they're taxed. With a traditional IRA, you get an initial tax deduction, the earnings grow tax deferred, and then when you eventually take the funds out, they're taxed at ordinary income or your marginal tax rate. With a Roth IRA, you don't get that initial tax deduction, but the earnings grow tax-free. And then as long as you meet certain requirements, when you take the money out, it's free of tax.
We love tax-free.
Yeah, that we do. The big difference too is that Roth IRAs tend to be a little more flexible than traditional IRAs. It's easier to access that principal, even before that 59.5 number. And then with a traditional IRA, you're subject to RMDs or required minimum distributions at 72. That's not the case with Roth IRAs. So Rob, can you go ahead and give us the contribution limits for traditional IRAs versus Roth IRAs? Maybe take a minute or two to explain the difference between deductible and non-deductible contributions.
Yeah. So I think to keep things straight and as clear as possible, I'm going to just start with the traditional IRA and focus in on a deductible contribution to that traditional IRA. When I say deductible, what that means is if you basically make it your maximum contribution, which would be $6,000, assuming you're under 50 in 2022, you're going to get a tax deduction on your tax return when you go to file it. So we're assuming that you're going to use the cash in your bank account to fund that traditional IRA, which is typically the case. So that's the deductible contribution. The non-deductible contribution, I'm thinking actually we wait and cover that a little bit later because we can kind of tie another topic in with that. But another assumption here, because there is a few nuances that come with the traditional IRA in terms of contribution limits, one being your status as a participant in an employer-sponsored retirement plan. So whether that's a 401k, a 403b, sort of anything of that nature, it has an impact on how much you can contribute to your traditional IRA with income limits in mind. So those income limits for somebody that is single, so they file a single tax return, they're basically going to have modified adjusted gross income of $68,000 or less in 2022. So that's assuming, again, that they are a participant, an active participant in an employer-provided retirement plan. For married couples, we're assuming, again, that both spouses are employed and they are actively participating in their employer-provided plan. The income limit or the modified adjusted gross income limit for those that are married filing joint tax returns is $109,000 in 2022. So as you can see, it's not a crazy high number. So a lot of times you may get phased out, meaning your income or your modified adjusted gross income is higher than you're able to contribute and get a tax deduction on your tax return. So again, that's not necessarily a bad thing. It's just there are some rules here to limit the amount of tax benefit that's out there for everyone. So just switching gears here then, when we're talking about Roth IRAs and making those direct contributions to Roth, it doesn't matter whether you're an active participant in an employer-provided retirement plan or not. It makes no difference. What matters for the Roth contribution is your modified adjusted gross income limit. For single filing taxpayers, that modified adjusted gross income limit is $129,000. So it's a bit higher than somebody who's single but is actively participating in a 401k or a 403b. But it's still not it's not a crazy high number. There's still some limitations here. And then the income limit threshold for married filing joint is $204,000 in 2022. So I think I covered what I wanted to with the contribution limits there. So let me ask you this, Cam. When would it make sense for someone to decide to contribute to a traditional IRA as opposed to a Roth IRA?
Okay. All things equal, keep in mind, I'm making this very black and white for this scenario, but all things equal, it would make sense to contribute to a traditional IRA if you think your income is going to be higher now than during retirement. Conversely, if you think your income is going to be low right now, it makes sense to do the Roth so you can utilize that low tax bracket and then not to worry about it down the road. That being said, I think a lot of people underestimate what their future taxes are going to be. For a couple reasons, but one of the main ones being that if you've done a good job saving, you have other tax deferred vehicles out there. When you hit 72 and you're subject to those RMDs, if you have a large balance, that can bump you into a very high tax rate. Even if you don't want to spend it, you're still subject to take those RMDs. Also, we can't predict the future. I don't have a crystal ball. This might age poorly. But if I was a betting man, I would guess that taxes are going to be higher in the future than they are now. You can probably speak on this lower than I can because you've been a CPA and all, so I'd love to hear your 2 cents on what your thoughts are on future taxes.
Yeah, tax rates are we're in a historically low tax rate environment. Realistically, just given the amount of money that just after the first stimulus payment that went out during COVID or the pandemic, they were estimating that if we were to keep and kind of stay on the same track that we were as far as the tax code goes, it was going to take like 11 and a half years to recoup that money. And then I think they sent out another 2 stimulus checks after that initial round. So someone's footing the bill for this. I've been saying it the entire time. It's going to fall back on the taxpayer at some point. Sure. It's just a matter of time. So yeah, I think it's very safe to assume that tax rates are going to be higher in the future. And it may not be much. It may be 22% jumping up to 24%, but it's a difference.
Sure, and again, it's not always just black and white. Again, there might be scenarios in which a particular year it makes more sense to go into a traditional IRA because for some reason, your income, you had a huge bonus, your income shot you up a huge tax rate. And then the next year you go to Roth. But again, it really just depends on the scenario, and that's where you would meet with a professional to see what makes the most sense for your individual plan.
Yeah, and that's why we do tax projections and things like this, and we ultimately actually wait until usually the end of the year to make any decisions as far as contributions or conversions or anything like that, because we want to have a really good idea of where income lies, just to make sure that we're taking advantage of the right investment vehicle at the right time. But Mark, how are we doing?
We are at 2 minutes, 34 seconds.
Well,
you think that you've got anything that you can cram in 2 minutes?
No, I think we cover enough. Again, I want to stay true to that objective of 10 minutes or less. So I think unless you have something else you want to add, I think we're good.
You know what, we were talking about Wyoming, and we saw like wild horses. Like that's how, it's the Wild West. I don't know, I think it's pretty, I still can't get over the whole thing, but it's a pretty state. It's a hike, and you better make sure if you're going there that you've got a full tank of gas, because we went a couple hundred miles without seeing a building.
Yeah. Well, there you go. You learned something about Ross and Wyoming.
Yep.
So can you hit the stop button on that?
Perfect.
All right. Well, that covers for today. Please, stay tuned. Thanks for watching. We'll continue to cover more subjects on Roth IRAs and Roth vehicles in general.
Thanks for joining us for this edition of the KMG Fiduciary Partners podcast. We invite you to catch the next episode in our series for real-world advice from the KMG team. Follow us on LinkedIn at KMG Fiduciary Partners, where we'll keep the conversation going.